Good morning, friends. Welcome to our video on technical tools you have never heard of. Now, I would strongly recommend that you see this video in its entirety to understand the vastness of technical analysis which exists out there. All of you have done RSI, you have done moving averages, you have done the standard chart patterns, the candlestick pattern, and so on. But here are a few tools which exist, which cannot be mathematically proven because technical analysis is an art and not a science. But with time and experience, have been extracted out from the market to provide you with much better profits than ever before. So our first tool today is the Hit Trendline case. Now we've been taught via books, via videos, via courses that the longer a trend line, the stronger a trend line, and the greater the number of hits on a trend line, the stronger the trend line. However, if a trend line is hit too frequently, especially more than 4 times, then the trend line, instead of becoming stronger, actually becomes weaker. Why? Compare it to a person who is knocking on my door wanting to come in. So the first time he knocks, I ask him to go away, he leaves. The second time he knocks, I ask him to go away, he leaves, and so on. But if his frequency of knocking and his coming to my door increases, his intention of coming in has increased. Hence, the 4-hit trendline case essentially captures the feeling that the higher the number of hits on a trend line, the greater is the probability that the trend line will break. And for that, I would like to show you a few examples. Now, take a look at this downtrend line in the Nifty. This downtrend line in the Nifty, it started here, was hit once, was hit, nearly hit twice, hit the third time, and in the fourth time itself, so 4 hits, it broke out, right? Again, here is another downtrend line in which a similar phenomena has occurred. This is not a trend line, but rather a channel line, right? Because this is going through market tops, but sloping in the upward direction. But even this, which may be treated as a supply line, is broken out in its 4th attempt. So 4 or more hits on a trend line actually weaken the trend line rather than strengthen it. Obviously, this is not going to happen every time. Please remember 2 things. One is every signal in technical analysis can and will at some time fail, because technical analysis is an art and not a science. Secondly, this video is an educational video. It is not meant for you to actually go ahead and place trades in the market, but to enhance your knowledge of the market and discuss with your portfolio manager whatever you have learned here, so that you can take and make appropriate trades in the market. So the second tool which we want to discuss is the 4 gaps in a trend case. What is a gap? A gap is an imbalance in demand and supply between 2 trading sessions. Normally, we look at gaps on daily charts. On intraday charts, there is a continuous trading, but because of an act of God, there might be an gap even in a intraday chart. However, let us take a look at the daily chart of Tata Motors. Now you can see that here Tata Motors is in a strong bull run. Now it made one gap here. This would of course count as a breakaway gap, followed by a continuation gap, another continuation gap, another continuation gap, which ultimately broke down into an exhaustion gap. But the number of gaps which appeared in this move were actually 4 in number, right? Now, after this, as you can notice, that there was a phenomenal fall in the market from almost 1065 to almost 900 levels. That means almost 200 rupee fall, which any technical signal which came here as a reversal would be automatically enhanced by the presence of these 4 gaps. So 4 gaps appearing in a trend actually enhance a reversal signal when it appears. Our third tool is the midpoint of weekly candle case. Now, what is the midpoint of a candle? The midpoint of a candle is the high plus low added together, and then the entire thing divided by 2. Over a period of time and with experience, it has been found that the midpoint of the weekly candle acts as a support slash resistance, depending on how the price is placed with respect to the previous candle, for the entire of the next week. Which means that if I take a look at an example of, let's say, the BSE, right? Look at these weekly candles of the chart of BSE. Remember, all charts which I am showing you are futures charts and not equity charts. So here the midpoint was 4312.83, 3956.20, and so on, right? Now, the breakdown or the breakout above the midpoint can be used as an entry point also in the realm of long-term or swing trading, keeping the stop loss at a few ticks below the midpoint. Now, obviously, this is a weekly chart, right? So this is meant for long-term traders. However, even for swing and daily traders, the weekly candle's midpoint is a very, very important level, above which the bulls are in control, below which the bears are in control. So the weekly midpoint taken out on Friday evening after you've updated your data, or on Saturday morning if you have not bothered to update it on Friday evening, will give you a level which will be valid for the entire of the next week. So this is something which is very important and not mentioned explicitly in many of the text. But the weekly midpoint is a very important level for short to medium traders in terms of time frame. Our next tool is the shark's attack case. What is a shark's attack? A shark, as you know, is a fish which is very dangerous and which attacks with great ferocity. Now, large institutions, when they want to buy huge amount of stocks, do not have enough liquidity in the market to satisfy their appetite for buying, or if they want to sell a large number of stocks, they do not have the liquidity to exit the market with the existing liquidity. As a result, they engineer what is called a shark's attack. A shark's attack causes prices to break what are universally known support and resistance levels, so that stop losses are triggered. When the stop losses are triggered, say buy stop losses are triggered, sell orders will come, at which time the institutions will rush in to take the sales given by the sell orders, and then the market will suddenly shoot up. So it is the shark's attack which leads to a lot of stop losses being broken and are engineered by high net worth individuals or institutions or hedge funds. Now, a couple of examples. Now, for example, take a look at the chart of Nifty. Here we had multiple support levels which were suddenly broken, right? Of course, this was an event, election results, but whatever it is, the institution must have been very active that day, and there was this breakdown. Also, the level of 21,500, which was considered a kind of sacrosanct level around those times, was broken, and a lot of stop losses must have been triggered. Who suffers when stop losses are triggered? The retail, the crowd. Please remember, the crowd is always wrong at market turning points. Therefore, here the crowd exited and then the market recovered only to enter into a massive bull run. Again, here, take a look at this. This is a demand line. It is a demand line, right? Now, in this demand line, we found support here, we found support here. Here, the support was broken for a couple of days. Now, here, basically what happened is, first of all, the level of 22,500 was broken. A lot of people exited, and then this long-term support line was broken. Finally, the market recovered, creating basically a morning star pattern here in terms of candlesticks. And then the biggest indication that the market was going to rapidly go up was this island reversal here with a gap here and a gap here at the same level. Here again, you can see that the market shot up, as we have seen currently, almost vertically. And remember that all vertical movements in the market are triggered by fear and not by greed, which means that the retail market participants were heavily short in the market, and it is bear covering or short covering uh, generated out of fear for excessive losses, which caused this market to shoot up like this. So these are examples of shark's attack. Our next rule is the 10% rule for all-time high breakout. Now take a look at this. When an all-time high of a stock is broken for the third time, please remember on the second time, there will be something called trader's remorse, which will cause a fresh outburst of sales at a previous all-time high. However, when it breaks for the third time, then essentially a 10% move is almost guaranteed. There is no 100% guarantee, but the probability of a 10% move is very high. Now take for example the chart of Coforge. Coforge had an all-time high of 6871.5. Now when this all-time high came a second time, approximately, you can see there was a pretty hefty fall. But when it broke again, after a small trading range, it went up by 10%, exceeding the 10% rule by a small amount. The 10% increase of 6871.5 was 7558.1. It actually went to 7618.5. Another example of the all-time high would be in Tata Motors. Now in Tata Motors, you can see that there was an all-time high made at 1067.6, followed by an almost all-time high, as you can see by the colored ellipses. When it broke out from here the third time, right away it went to, within 3 or 4 trading sessions, it went to 1178.45, whereas the all-time high was 1174.25. Right? Of course, this happened a long time back, but this, remember, history repeats itself. Therefore, this is valid even today. If an all-time high is broken for the third time, then the 10% rule still holds. Now, our next is the Hound of Baskervilles case, which is a signal which was formulated by Dr. Alexander Elder. I consider Dr. Alexander Elder as one of the best technical analysts in the world, and his books and his teachings are legendary. Now, Dr. Alexander Elder formulated the Hound of Baskervilles case, in which he said that if a technical signal does not move the way it is supposed to move, then there is something wrong with that signal, and one should be very careful not only in trading the signal but actually going against that signal. Now in this case, let's say in the case of Kotak Bank, we had a horizontal channel which was temporarily broken. Now the actual target of the channel would have been the height of this channel extended downwards, but no, that did not happen. In fact, the channel recovered. Well, it did give some trouble to traders, but somebody who was watching it carefully and watching the candlestick patterns would have noticed that this channel was actually not behaving the way it should. And had you taken a reverse call, can you imagine the kind of reverse move which came despite the channel being broken? Now, another example of this would be this example of KP IT Technologies, right? Here, there was a complex head and shoulders pattern. Now, you can see that this complex head and shoulders pattern should have broken down and given a huge target, probably around 800 levels, right? However, the pattern did break down, quickly recovered in form of a pullback, again went down, did not break this low, and then went above the neckline again. Now, ideally, this is the formation of a Hound of Baskervilles signal. However, with the current situation of the market, I would not recommend trading KPIT technologies immediately, perhaps waiting a little more and watching how it behaves around the neckline. Finally, the Hindenburg Omen case. Now, the Hindenburg was a Zeppelin which was made by the Germans during the Second World War. Now, the Hindenburg crashed on its maiden journey, killing a great number of people. You can watch a YouTube video based on the Hindenburg. Now, the Hindenburg Omen was formulated by a person called Jim McMika and named by Kenneth G. Tower, both of whom were renowned technical analysts. They aim to predict market crashes. The Hindenburg Omen is aimed to predict market crashes. Now, the conditions required are enumerated here, so I will not waste your time in going through the conditions. But essentially, they include a number of different parameters, including astrotechnical analysis, where it says Mars and Uranus cycle should be dominant. Now, the unfortunate part is that these conditions are normally true when a crash happens. But when these conditions are true, there is no guarantee of a crash. So this is a slight setback for the Hindenburg Omen. However, the Hindenburg Omen is still considered by many technical analysts as a powerful tool to understand that there is an underlying weakness developing in the market and to act on the next reversal pattern. So, friends, I hope that this seventh set of tools which you may have not heard of earlier will help you in your analysis and help you to reduce your losses, increase your profits. Please remember that the key thing in the market is twofold. One, reduce your losses. Look around you. How many people are making losses in the market? People are watching their losses, cutting their profits. Good traders cut their losses and watch their profits. Very, very important part of trading. And secondly is that good traders do not trade to actually make money. They trade to get their trade right. The satisfaction of getting a trade right is much more than the pleasure of making money. With that, we conclude this session, and our other videos on our technical analysis class will continue as usual. Thank you for watching.